Hi there, welcome to a new video that I'm recording. So this is basically been written by Eugene Lim. It's on this article which I found in Substack. It's called "Climbing the Wealth Ladder," and it's a really interesting article. And I thought, like all the ones in the series, I would really love to summarize this. If you haven't liked, subscribed, please do because it helps me unlock a lot of features on YouTube. So actually, before I start, please just take a moment to actually like the channel, and I promise to continue creating good content. Um, so when we look at this, basically, he's read The Wealth Ladder, which I haven't read, so that's a good shout out, and that's probably one of the books I will read and probably summarize in some future video if I go down that path. Um, Shout out to actually David Sender from Founders. He's sort of the inspiration for me to try out this. Also Ali Abdul, who I've been watching for a long time and have been trying to create YouTube videos. Um, all right, let's sort of go through this. So essentially, he talks about this framework. So he's talking about six levels, and then you're essentially going from less than 10,000 to over 100 million. And then he goes on to say that, from level 1 to 2, which is you're going from less than 10,000 to about 10,000 to 100,000 in net worth. You need marketable skills from level 2 to 3, which is going from 100,000 to a million. You need education that unlocks higher wages. From level 3 to 4, you shift to investing in income producing assets. So that's 1 million to about 10 million. And here's where it gets interesting, which is that he says that when you need to go from 10 million to 100 million, you need to own a business that is by equity. And then finally, you reach the greater than 100 million, which is you need to scale that business. So, one of the things that I found which was interesting was that he talks about atypical actions. So he's saying that at level 1, which is when you're less than 10,000, you're actually focused on the basics. So you want to reduce debt, build the emergency fund, develop marketable skills, stuff that you would typically do when you're out of university, and you're sort of starting to get, you're sort of starting out, right? Then essentially he talks about level 2, which is 10,000 to about 100,000, and then it shifts to learn today, on forever. So this is all about building a skill set, a niche skill set that you can scale. It's about finding the intersection of your strengths, the interests, and what people will pay for. He's talking about education becoming an investment, not an expense, which I think is a common case across the globe. Obviously, the U.S. universities tend to have higher education costs, but then you also realize that it's sort of made up for in the wage that you're able to make. And he does highlight that the trap to avoid at this particular stage is to avoid dead end jobs that ignore opportunity costs. Um, and then he goes on to talk about why high salaries are not enough. So essentially, he's talking about taxes. So there's only two truths in life: there's death and taxes. Um, and then if you sort of, there was actually this great movie which had uh, Brad Pitt, and it had I think it had Anthony Hopkins, um, and that was like. A great film. And that's where this line is from. I just can't recall the name, but yeah, if you do know which movie it is, do put it in the comments. Okay, moving on. So your compensation stops the moment you stop working. Take a sabbatical, the paycheck pauses. Meanwhile, your friend's rental property or business keeps generating cash while they sleep. The higher your salary, the scarier it feels to step away, which I think is true for most people today. He then goes on to say that creating golden handcuffs that are surprisingly hard to break, which a lot of people, especially mid-career, whether it's starting from the late 30s all the way up till the 50s, that's what they start to feel. So if you don't start earlier, it typically tends to get harder. Obviously, there are exceptions. For instance, um, you had the likes of Instagram, which was started out quite late. Warren Buffett started and made a lot of his, sorry, Buffett made a lot of his wealth actually a lot later in his life, post the 60s, even though he started much earlier. Um, I think there's like countless examples of that that I could think of. Ingvar Kamprad, I think the founder of IKEA, if I've not butchered his name, uh, he had that as well. So yeah, like there's countless examples of that. The wealthiest people did exactly the opposite. They concentrated their bets on ownership, then diversified after winning big. Think about any tech founder holding their company stock through the IPO and beyond, only diversifying once generational wealth was secured. And I think this is something that is quite common to the likes of Steve Jobs, Larry Ellison, uh, Larry Page, Sergey Brin from Google, uh, Zuckerberg. All of them are essentially they've made sure that they've Elon Musk even with regard to Tesla, right? So all of them sort of made these bets which were pretty impressive, and then they once they've sort of like made that initial generational wealth, that's when they started taking a shot at all the moonshots. A high salary, no matter how impressive, is defensive wealth. He then goes on to talk about the leverage problem, which is essentially, it's from the uh, uh, Almanac of Naval Ravikant. So if you haven't read this book, it's a great book. It summarizes all of Naval's Navalisms, and it's a fantastic read. So if you haven't read that, I think you should drop everything and sort of go and read this book. It's very relevant today. If you haven't heard, actually, there's a great podcast episode which is called The Angel Philosopher. Uh, it's on on this podcast, which is by Shane Parrish. Um, it's called the Knowledge Project, and he has a great blog. It's called Farnham Street. So if you haven't actually gone through any of that, it's amazing. There's also a novel interview which is with Tim Ferriss, which I find to be pretty impressive as well. But I think if I had to sort of rank it, I would probably put the interview with Shane Parrish a lot higher than the one with Tim Ferriss. Yeah, so I think both of those are great. And then of course there's a new one that came out earlier this year. I can't remember which channel it was on, but if you search for it, it should be pretty easy to find on YouTube. If you actually do like and subscribe, and I manage to get some followers, I can actually start putting live links, which supposedly Google doesn't let me do until I have a minimum number of followers. Anyway, going back to this, so leverage problem, right? So labor leverage. Managing people is the oldest form, but it's messy, difficult, and doesn't scale well. A law firm partner managing 50 lawyers still has leader constraints, which I think we all realize. And then there's capital leverage, which is money amplifies decisions, but you need capital first. This is where your high salary becomes rocket fuel, not as the end goal, but as the means to acquire leverage. And then, of course, there's the products with no marginal cost of replication, which is the focus that Nabil has, right? Which is he's saying that code, media, courses, system. So you build once and you sell forever. So it's like a software engineer who's billing $500 hits a ceiling, but he who packages his expertise into a SaaS product or joins a startup with meaningful equity breaks through it. So that's essentially what you sort of have to do in when it comes to this particular leverage problem. Then essentially from level 3 to 4, which is you're going from 100,000 to 1 million, and then you're sort of breaking that ceiling and going from 1 million to 10 million is sort of the accumulation phase. And the good news is that the transition from level 3 to level 4 doesn't require you to actually quit your job. Um, and he then says that just keep buying is basically the mental model that you have to sort of follow at this particular stage. Um, but then he then goes on to say something very interesting, which is that the next shift is where I think it gets interesting. Level 4 is achievable through salary, but level 5 is not. Even the highest earners hit a mathematical wall. And that's where he basically goes on to say that, there's the ownership imperative. So you have to watch your health, stay out of things that can cause you to lose all of your capital, all of your savings. So you know how people sort of come into money with crypto, and then they will make a lot of crazy bets. The intent should be that once you've sort of built a corpus which is sizable enough, it should be all about protecting that wealth rather than trying to scale it 10x from there, because you already have enough money to sort of see you through for the remainder of your life. So then essentially, what Naval is saying is don't gamble everything on one go, but take rationally optimistic bets with big upside. So what you're doing is you're sort of still taking those bets, but you're trying to make sure that those bets are not crazy in any way. And then he talks about the exceptions, which is that, senior executives, Fortune 500 companies, AI researchers at frontier labs, commanding seven-figure packages, and investment bankers at elite firms can potentially reach level five through compensation alone. So those are obviously the exceptions, but a lot of us are not in those. So if you're there, then it's all good. If you're not, then you have to think of alternative ways to sort of break that ceiling. He also goes on to say that they represent only 0.1% of high earners, and then the remaining 99.9%, um, those earning impressive salaries in the 300 to 500,000 range, the math simply doesn't work out. The jump from level 4 to level 5 is where the salary game breaks down entirely. The mental framework shifts. What got you here won't get you there, which is also something that I saw on LinkedIn more recently, right? It's more about um, how do you sort of um, change your wealth advisors, right? Your wealth advisor who sort of was advising you to get you from 10,000 to 100,000 is not the same guy who can get you from 1 million to 10 million. So as you sort of upgrade in life, these are some of the upgrades that you should pay for, not for all the other rubbish things like luxury spend or lifestyle creep or just the typical hedonic treadmill spend that would keep you in that infinite loop forever. What you should be paying for is expertise, valued expertise, which can actually help you break these ceilings. Um, And then he speaks about the 90-10 rule. If you're earning at this level, you can save for for that guaranteed retirement and still have serious capital for asymmetric bets. Life is essentially all about asymmetric bets. So 90% goes to the traditional path, which is 401k, index funds, mega backdoor Roth. Or a lot of these will not apply depending upon where you are. These are very US centric, but then he says 10% of gross income goes to asymmetric bets. So he's saying that over 10 to 20 years, you make about 40 to 80 bets, even if all of those go to zero and the last one goes 100x, that's the winner piece for everything. This is literally the VC model as well, which is like Power Law. If you haven't read The Power Law, actually, it's by Sebastian Mallaby. I just finished another book by him, which is More Money Than God. Both those books are phenomenal. Power Law is very VC centric. It talks about how Silicon Valley came to be. Silicon Valley, how did all the venture funds sort of develop? It starts out with Don Valentine and Sequoia. It talks about a lot of the early partnerships. It talks about how Intel was formed. Um, uh, you know, from I think it was Fairchild Semiconductor, and then how it translated into Intel and so on. It goes on all the way to talk about the more recent VC firms that we sort of started seeing across the globe. It's a very interesting book. And then More Money Than God, which is all about hedge funds, again, starts out super early. Um, it talks about the 1960s, the 70s, how this wave of hedge funds started to develop. It also talks about Citadel, which a lot of us would have seen and heard about more recently, especially with all the GameStop saga. He also touches upon how George Soros sort of set up his shop. It talks about long-term capital management. So a very interesting book overall, in case you want to have a deeper understanding of hedge funds in general. All right, going back to this. So 60% of angel investments fail completely, 30% return modest multiples, and only 10% generate 20 to 100x returns that make the portfolio work. So I think that is something that you should think about as you're sort of making these. I did draw this, so I think just in terms of the power law, if you think about it, right? While 90% of startup employees see their equity worth nothing, those who join pre-series A startups that exit can see 50 to 500x returns on their equity value. So if you think about the power law, right, it could be uh, yeah, inward or outward facing. So if you just look at this graph, right? So the bulk of the employees will get like terrible returns, but then you'll have the 1% employees, which is essentially at this end, who will make crazy amount of return. So that's where you essentially want to be when you're sort of also betting on joining a startup or investing in a startup. Earlier means riskier, but potentially life changing. And then he basically goes on to say that even failed startups provide what I call compressed experience. You learn 10 years worth of lessons in 2 years. You see every part of the business, make decisions with real consequences, and build a network of other risk takers. this human capital compounds even if the equity doesn't. And I think this is a great example because this is something that I've seen with one of my college friends who's basically been at a startup since he graduated, and he's actually seen, on paper at least, his equity multiply. But then more than that, he talks about the experiences he's had. He's in a decade probably packed in more learnings than a lot of people who would go down a typical corporate path, and they would essentially take more than 20 years to make those same mistakes, learn from those. Also, he's more exposed to different parts of a business, so he's working with finance, HR, ops, anyone and everyone to sort of learn all of these things, which is highly impressive. Uh, Coming back, so he talks about join 2 to 3 startups over a decade, ideally at different stages. So the first one, you're employ 20 at Series A, second one, you employ 5 at a seed stage company, and then perhaps eventually you do, start your own startup. So that's what could potentially work. And then he goes on to talk about real world patterns. So most people he knows who have reached 10 million did it through early employment at successful startups or by rising through the ranks at big tech companies while holding significant equity. What he then goes on to say is they kept the day job until the equity became real. Salary was a risk buffer, not the price. They understood that index funds preserve wealth, but concentrated equity creates it. And I think this is also something that Monish Pabrai recently said in one of his interviews. And he's continued to sort of talk about this on multiple platforms. So I think if you just search him up on YouTube, you'll realize that, hey, this is a very interesting thought. And he's also talking about keep the day job, build your side business, um, eventually scale it. When the side business becomes big enough, that's when you can actually sort of leave the cushion off your day job and sort of start working full time on your side business. When RSUs hit like clockwork, risk looks irresponsible, but getting laid off at 55 with golden handcuffs also irresponsible. Missing the window to exercise creativity while energy is high, same. Again, it goes back to the point that it's been there throughout the course of this video and this article. Basically, if you don't start early, you're essentially going to miss out. But that being said, you should also not be naive and start when you are sort of betting the whole house. What you should do is you're sort of betting the garage while you still have the house paid for by your existing employer. All right, level 5 to 6, which is 10 million to 100 million and then greater to 100 million, right? So that's level 5 is the first one, and then greater than 100 million is the level 6. So he basically talks about that, I don't believe climbing to level 6 is worth it. The difference between 50 million and 500 million net worth might be negligible in terms of lifestyle, but enormous in terms of stress and responsibility. And I think this is something that I was recently, earlier this year, actually, I read The Algebra of Wealth. Uh, I think it was by Scott Galloway, if I'm not mistaken. And I think he also echoes the same thing that after a certain amount of disposable income, the incremental increase in happiness is sort of negligible. But as long as you are able to maintain that consistent income adjusted for inflation over your lifetime, you'll basically end up being happy because that's when you prioritize experiences over um, material gains. He then goes on to talk about this great example, which is actually from Morgan Housel's Psychology of Money. Shout out, just finished reading The Art of Spending Money, which is fairly interesting. I think I definitely liked it more than his second book, which is Same as Ever. I think this book, and probably do a video at some point in time, is pretty interesting. A lot of interesting concepts, a bunch of parables. Some of the themes are quite similar to what we already know, but it's good to read the book because it's sort of a reassuring reminder as to what we should be headed towards. I've heard mixed reviews, but I think personally, measured in terms of the number of highlights I've made in the book, it's one of the better books that I have read this year. So anyway, going back to the story, he talks about how Kurt Vonnegut informs Joseph Heller, who wrote Catch 22, that hey, that there's this hedge fund manager, he's made more money in a single day than you've earned over the whole history, and then Heller responds, yes, but I have something he will never have, enough. And I think that is just a great way to think about that earlier example of skimming from the algebra of wealth as well. That, after a certain threshold in terms of income, once you've reached it, any incremental income does not actually add to your happiness. So yeah, I think that's a way to think about it. All right. And then I think essentially he's sort of summarizing the a larger chunk of the article, but I think what was probably the highlight was this last line here, which is the strategies that got you here won't necessarily get you there. And knowing when to shift gears from employee to investor might be the most valuable skill of all. Um, Out of these books, I've essentially read Almanac and Psychology of Money. Both of these are highly recommended. I will get to these other two, and I will sort of give my views on that in the near future. So if you do want to read this, do check it out. The article is called Climbing the Wealth Ladder. It's by Eugene Lim. He's actually written a bunch of other articles as well, which I will be reviewing in the coming videos. But until next time, see you around. Thanks so much for listening. Please do like, share, subscribe. My name is Udit Sabharwal. See you.